Berkshire Hathaway is built to weather any storm, and it's been an incredible investment for 6 decades under Warren Buffett's leadership. But Buffett turns 95 later this year, so his days as CEO are eventually going to come to an end. The company's annual meeting is this Saturday, May 3rd, so we thought it would be a good time to consider whether Berkshire can beat the market when Buffett is no longer the CEO. Before we dig in, my prediction. I don't think Berkshire is likely to remain a market-beating stock once Buffett is no longer the CEO, but it's probably not for the reasons that you think. All right, let's dig in. Since Buffett took over what was a struggling New England textile manufacturer in 1965, Berkshire Hathaway has been one of the most successful investments ever, returning more than 5.5 million% for its shareholders through 2024. For comparison, the S&P 500 generated about 39,000% in returns. Now, that was actually really good, though it pales in comparison to what Berkshire's done. What may be surprising is that Berkshire has continued to outperform the market in recent years, gaining almost 273% versus the S&P 500's 223% in total returns over the past decade. Now, how can Berkshire continue its outperforming ways post-Buffett? It starts with the people running the show. Berkshire hasn't been putting people into positions to take over Buffett's role since 2010, when Todd Combs joined the company to help manage its massive investment portfolio. He was joined by Ted Weschler in 2012, helping with that same role. We also know that Ajit Jain, the most important executive in Berkshire's insurance business, has taken on more responsibility, and Greg Abel, who ran Berkshire's utility business for decades, is the named replacement for Buffett as CEO, and he's already a board member. So the table's already set for a steady transfer of power. Berkshire's also renowned for leaving its subsidiaries largely alone. I don't expect Abel is going to change that. I also expect we will continue to see Ted and Todd continue taking on more leadership roles with more subsidiaries reporting to them, even as they take on that full responsibility for managing Berkshire's investments, including stock, treasuries, and cash. It really just boils down to doing what Berkshire has done so well under Buffett. Smart capital allocation, paying reasonable or even cheap when possible prices to buy excellent businesses, whether that's buying stock or full acquisitions. And then those acquisitions fund the cash-generating engine that drives Berkshire's ability to continue investing in more and more opportunities. The bear case is a combination of things. First, Ted and Todd, according to Buffett, have done exceptionally well as capital allocators, but it's becoming harder and harder for Berkshire to find opportunities that are both attractive enough and large enough to be material. Forced to do more smaller deals is hard to do well, and there just aren't as many big opportunities where Berkshire can put its hundreds of billions of dollars to work. Next, there's risk of a deterioration of the results from the subsidiary businesses. As Buffett told us in a shareholder letter recently, more than half of Berkshire's 189 operating subsidiaries reported a decline in earnings last year. It's possible we see those profits continue to fall, particularly if many of those core companies have underinvested in recent years, sending proceeds back to the corporate parent to fund the stock buying machine. We're also seeing more and more turnover of leadership in those subsidiaries. Buffett personally negotiated to buy most of those companies, often from their founders, many of whom remained at the helm with their leadership teams under the Berkshire umbrella. As the decades have passed, those founders and the management teams they built, they're no longer running the show as much. Berkshire's minimal involvement in those subsidiaries could cause it to overlook emerging issues, including poor succession planning and failure to maintain their competitive advantages. Now, I love Berkshire Hathaway. I'm a shareholder. I'll be at the meeting this year, and I have no plans to sell my shares. But I don't expect the company post-Buffett as CEO is likely to outperform the market. But it's not because Buffett won't be in charge. I expect he'll step down as CEO soon, but he's going to remain chairman for some time before retiring, or maybe following his longtime partner and former vice chairman, the late Charlie Munger, remaining in that role until the end. But the reason I don't expect Berkshire to outperform over the long term is not because Buffett may be stepping down as CEO soon, but because, well, it really hasn't been that much of a market beater for many years. Yes, it's outperformed over the past 10 years, but almost entirely because its stock has held up this year while the market has sold off. During most of the market's bull run since 2009, Berkshire stock has underperformed the market. Shares also are relatively expensive right now. I think that's likely to further weigh on future returns, leading to strong performance, but probably not as good as the market over the long term. All right, let's wrap this up. At the Motley Fool, your comments make us all smarter. Please comment with your own research and insights about Berkshire. Tell us what stock you want to see us tackle next. Go to fool.com/invest to receive the top 10 best stocks to buy now.